Facebook may represent the new media, but some of the old media companies also reported their earnings today, and the results were pretty good. After the bell, we heard from CBS. Remember that company? They got 60 Minutes and other shows. It saw profits rise 22% last quarter on higher ad rates for the Super Bowl and a jump in revenue from cable carrier fees. Comcast, the owner of NBC Universal, which is the parent of CNBC, which produces this broadcast, made more than expected with growth in its theme parks and cable channel units, even though it lost more cable TV subscribers. And Time Warner made more than forecast last quarter on the strength of CNN, HBO, and other cable networks it owns, despite weakness in its movie studio and notably its publishing business. And if that wasn't enough to show you that some of the old guard is still doing pretty well, shares of two more media giants, Disney and Viacom, each touched all-time highs today on a down day in the markets.
Joining us now to talk about the investing opportunities in all kinds of media companies, Larry Haverty. He's portfolio manager at Gabelli Funds. Larry, let's begin with Facebook. I know you've been recommending it, and now that you've seen the numbers, do you still feel that way after seeing those earnings?
Oh, yeah, absolutely. The key statistics here are not the earnings. They're the revenues and the engagement. And the ad revenues grew 43%. Google and Facebook in the next 5 years are going to capture all of the incremental growth in global advertising dollars. And you can see this in Google's revenues. You can see it in Facebook's. Now, the question is, how fast is Facebook going to convert this revenue to operating cash flow? They didn't get a particularly good grade in this quarter. They only converted, I think, around 25%, which is pretty low since you have a company that doesn't really sell anything. It zaps bits. So they're spending a lot of money on initiatives. It's kind of like Amazon. I think the market is going to give Mark a hall pass on showing EBITDA for a while. And we've seen Act 1 of the movie, which is collecting the dollars. Act 2 is converting them to profit, and we'll just have to see. I think the stock's fairly priced here. If it goes down, I think it becomes more attractive, and we'll just have to wait. It's not a definitive proposition. I think the market figured that out after hours.
You know, Larry, we've used the construct of new media versus old media, and obviously new media companies and old media companies cross-pollinate and they connect in various ways. Let me cut to the chase here. If you had $10,000 to invest over the next 5 years, how would you apportion it between or among new media companies, as we traditionally think of them, and old media companies, and which specific names would get the most of that money?
I'd go at least 50% in new media, and I think the biggest position would be Google. Google's very reasonably priced. They win in search, they win in video, and heaven only knows, Tyler, what's going to happen with Google Glass. Google Glass could be really enormous, and it's a free call. I'd maybe put 10% in Facebook, and I'd put 15% in Yahoo, largely because I think this proposition with Alibaba in China is going to be a spectacular success, and we'll have to see when Alibaba goes public, which I think will happen at the end of the year. Maybe the rest of it, though, in old media, it's not so bad. The collection of ad dollars is problematic for these people, but what they've done is they've figured out a way using technology to get their content viewed on more platforms. And CBS has done this with its cable network. Time Warner has done it with HBO Go and TV everywhere. And you're getting these new streams of people paying for content like Netflix and Amazon, and then the TV stations are collecting retransmission consent. And the beauty of this, Tyler, is it's about 90% incremental profit because they're not really spending a whole lot more money to produce the content. So the incremental margins are terrific. The companies are generating in the neighborhood of 8 to 10% cash flow growth. And the managements have all gotten religion about how to distribute that cash flow growth to the shareholders. I think Time Warner has gotten the most religion. They now pretty much are distributing 100%, but CBS is right up there with them.
You have a lot of good information. We're going to have to leave it there. Any disclosures to make? Do you own any of these stocks that you've just talked about?
We own them all.
You own them all. Okay, fair enough. Thanks so much. Larry Haverty, portfolio manager at Gabelli Multimedia Trust.